Hello, I'm Hunsley from Livewire Markets, and welcome to our Fund and Focus series. Our guest today is a Livewire favourite and one of the top investors in his field. It's Dr. David Allen, who runs the Plato Global Alpha Fund and the unique long-short strategy that comes with it. The fund will soon be available to investors as an ETMF under the ticker code PGA1. Welcome, sir. Nice to see you.
Welcome, Hans. Great to be here. Thanks for having us.
So this fund, how's these for some performance numbers, folks? This fund returned 32% last year. It's up 44% year to date, and it's returned 10% per annum over its benchmark over the life of the fund. So what are the main sources of alpha that have contributed to this outperformance?
A good thematic in the fund has been defence. Basically, I think since Crimea, every country in the world is re-militarising. So companies like BAE Systems, like Rolls-Royce, that's up a couple of 100%. 25% of their portfolio is defence. Have done very well for us. The great thing about defence is there's that old adage that defence is defensive. These names are actually low volatility, low beta names. So despite the fact they've got this secular tailwind, Brussels just said they're going to devote billions and billions more to national defence. They're actually low volatility as well. So it's this, this interesting case where you're getting higher return for actually lower risk. So defence is definitely an exciting one. I've come in and spoken before at the Livewire shocking predictions 12 months or so ago about the end of obesity, which got lots of interesting feedback. But it's remarkable. If you look at the obesity stats in America, of all places, for the first time ever since data was collected in the 50s and 60s, the curve is actually inflected, and you are actually seeing a reduction in obesity levels. And the driver, of course, are these incredible medicines from the likes of Novo Nordisk, Eli Lilly, that are allowing people just to shed kilos and have a huge benefits on their health in terms of everything from arthritis, diabetes, heart disease, fertility, even potentially Alzheimer's and addiction. So some great medicines there that we've definitely benefited from. The shorts have been a great driver as well. We've generated 70% of the alpha on the shorts, and this environment that we've gone through where rates have gone from a pretty depressed level to ratcheted up very, very quickly, that's really applied the blowtorch to companies that were frankly valued incorrectly and had too much debt and so forth. So I've spoken about names like Aussie names like Weebit Nano and BrainChip in the past, where they had lots of red flags on Plato's red flag system, and they've really underperformed and helped drive that alpha for us.
Yeah, no, absolutely. So with that said then, how are you viewing the opportunity set for long opportunities, and in contrast as well the opportunity set for shorts?
I've been running long-short strategies since 2007, and I can say that some environments, from a macro perspective, really conducive to generating your long alpha. And that's actually most of the time. Most of the time, it's more conducive to generating alpha for your longs. But the last 3 years have been not an anomaly, but it's definitely had the tailwind behind your short alpha. A good example, in month before last, we saw the Fed cut from rates not 25 but 50 basis points. It was a bit more than people expected. China unleashed some credit stimulus, and what you see in that sort of environments, the shorts, particularly the distressed names, can bounce a bit, and it can be a bit of a junk rally. And in those types of periods, the shorts do less well. So it's not necessarily when interest rates are decreasing, but if they're decreasing faster than people anticipated, that's when the balance tends to shift to being more favourable on the long side than on the short side.
So we've got the Australian stock market sitting at near all-time highs right now. And I guess with that in mind, are you finding more long or short opportunities at the moment in the Australian equity market, or is it different by sector?
Australia does have more than its fair share of companies with a high number of red flags, and tends to be a very fertile area for us to find shorts. From a valuation perspective, and this applies equally to Australia and the US, valuations are at all-time highs in many cases. If you look at the US stock market since 1881, The Schiller PE, which is like a mainstay of probably the most respected valuation metric at the market level, that's at 36 times. If you look at it since 1881, that places it in the top 3 percentile of expensiveness. So there's no debating it. Things are very expensive at the moment. But there is some phenomenal growth there and some companies that are throwing off generational levels of free cash flow. So I don't think that you can draw an analogy with the tech bubble and say, that this is a crash is imminent. In fact, when you do the research, I wrote a piece on Livewire about exactly this, the correlation between valuations in terms of a Schiller PE, for example, and the returns over the next 12 months are almost zero. So it's very tempting and very seductive to think, valuations are high, a crash is imminent. The data doesn't support that. It is, quite informative if you've got a 10-year horizon for investing. The Schiller PE and valuation for Australia or US market is quite predictive. Unfortunately, a lot of people don't have 10-year horizons, even if they say they do.
You mentioned your red flag system there. I was wondering if you could kind of elaborate on that a little bit more. What are maybe examples of some red flags that you look at for as well?
Buffett's very fond of saying there's only 2 things you need to know about investing. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1, right? And that's really what the red flags is all about. Preserving capital on the long side. So there's names like really interesting name was Settle, which Livewire did a phenomenal job. Ali did a phenomenal job of covering. And that was a name we were actually long. And we were like, it's a phenomenal growth story. I think their revenue had gone from 0 to 700 million inside of space for a few short years. But their red flags kept like piling up. And we were like, this looks a bit too good to be true. Red flags got to 12 and we said, okay, let's head for the exits. And we're probably fortuitous there in our timing. We did. Stock price was down, I think 50, 60, 70% since that point. So the red flags are an invaluable tool for capital preservation on the long side, but also as a means to identifying some great short ideas. So ideas where these are companies that they may look superficially strong, but there's weak governance. For example, lots of related party transactions. We saw that with MinRes recently. Where the auditor may not be of the standard that you might expect. MinRes was another one. They were using an auditor that I believe wasn't used by anyone else in the ASX 200 up until a couple of years ago. They were using this auditor. That's very important. We use a lot of tools from the forensic accounting literature that are the mainstays of identifying anomalous numerical patterns in the accounts. If you're ever having trouble sleeping at night, I highly recommend you read it. We have great data on the corporate history of executives. Have they been involved in misconduct in the past? Because people don't often change their ways, unfortunately. We look a lot at no matter how much information or data we have on a company, the companies themselves will always know far more about their inner workings. So one way to reveal what's actually going on in a company is the director buying and selling. When you look at the evidence though, most director buys and sells are not very informative. And if you just follow the money in a very robotic fashion, it doesn't actually help you very much at all. You need to identify which buys and sells are really informative. And the sells, for example, that are really informative are when the stock price has been hammered. 80% of the time when CEOs and CFOs are selling their own stock, is profit taking, the stock's done well, and that's rational and it's diversifying, makes sense, right? But when the stock price is down 50, 60%, and then they're saying, okay, I'm selling $1 million worth of stock, it's telling you it probably ain't coming back. Liontown, great example of that. 22nd of December last year, right before Christmas, CEO sells $1 million worth of stock, and we were already short at that point, but a month later or a little bit after that perhaps, they're forced to disclose to their market that their entire financing syndicate had fallen through. So follow the money in the right instances is really valuable as well.
Yeah, follow the money is always good advice. And on the red flags thing, and speaking of Ali, hi Ali if you're watching. Ali and Dave have just done a piece together on red flags and ASX 300 stocks that do have a lot of those red flags, and I highly recommend you check it out. We'll put that link in the wire as well. So that's red flags and that's shorts. What about longs? I mean, what is your criteria for buying and selling when it comes to long positions?
Yeah, so the criteria actually for the longs is a mirror image of the shorts. So we're looking for high quality businesses, trading at a discount. There's some catalyst or a sentiment and low number of red flags. Most of the time when you see a company that's a really high quality business, unfortunately markets are pretty efficient and it'll be trading at a rich multiple. So we're always applying discounted cash flows. This is a great quality business, but it's actually the market's missing something. That only happens once or twice out of 10. Value stocks, though, cheap stocks, as we all know, they can keep getting cheaper year after year. No good being right. If you're right 10 years too soon, you'll be out of a job. So we'll always wait for the sentiment to turn, for the momentum to be coming our way before we'll take that position. And then, of course, making sure there aren't too many red flags that could come back and bite us.
Yeah, absolutely. So with that said, I'm wondering if you could tell us about a long position you currently have in the fund and why you own it.
You know, one sector that's going to be a big recipient of the Trump victory is financials and banks in particular. And a name that we really like is JP Morgan. They're probably the best. Most people would agree they're the best run bank in the world. Their net interest margin 30% higher than CBA. CBA trades at a valuation, I think last I checked, was about 25 PE. JP Morgan at 11. So there's some great value opportunities out there for sure that we really like that are going to get a big tailwind with Trump in the White House for sure.
Yeah, okay. JP Morgan there. So just finally to put this all together, we talked a little bit about the longs, a little bit about the shorts, a little bit about the process. So for people who want to access this particular opportunity, what's the minimum investment for accessing the fund? And in case they don't meet the minimums, where can they now access it?
The minimum, if you want to go online to Plato Investment Management, is $15,000. So it's a very, very small minimum. But now it's available as an ETF coming November 25th. You can trade it as a stock, and there's essentially no minimum. You can trade in and out of the stock, daily liquidity, and yeah, it's a great opportunity to get in and out of companies without too much funds without too much paperwork.
All right. Well, good luck with the launch, and thanks for joining us. That's Dr. David Allen of Plato Investment Management. And thank you for joining us. If you enjoyed that interview, you can subscribe to the Livewire Markets website, as well as our YouTube channel, where you can find more funds in focus. Take care. We'll see you next time.